At Insightful Value, we love digging into the companies everyone else forgets, especially when their stock is falling, but their fundamentals are holding up. And today's spotlight is Kagome, the Japanese food powerhouse whose share price has quietly slipped, raising one key question. Is this a moment of opportunity or a red flag waving? This review is for informational and educational purposes only, not financial advice. Kagome Coors Limited, founded back in 1899, is best known for its tomato-based products, ketchup, sauces, juices, and its growing presence in plant-based health food. It's a brand most Japanese consumers know well, with a strong reputation built on natural ingredients and sustainable farming. They're also exporting that legacy, expanding into Asia, Europe, and North America. Kagome's business model is defensive by nature. People eat, recession or not. Their revenues come from processed food, fresh vegetables, and beverages, which tend to be stable. In the fiscal year ending March 2024, Kagome reported around $206 billion in revenue, relatively flat year over year. Operating profit came in at roughly $115 billion, with a margin just above 7%, and net income was about $10 billion. Not explosive growth, but a reliable profit engine in an unpredictable global economy. The problem? Investors are currently focusing on weak short-term forecasts. The company recently guided slightly lower earnings due to higher raw material and logistics costs, especially for overseas operations. Combine that with a generally cautious Japanese stock market, and you get a stock that slid nearly 20% from its recent highs. But here's the twist. Kagome is still profitable, still paying a dividend, and still trading at a relatively modest valuation. Their dividend payout ratio is around 40%, with a yield currently hovering near 2.5%, modest but backed by real cash flows. The company has increased dividends slowly over the last few years, reflecting a commitment to shareholder returns even in uncertain times. Their balance sheet is healthy, with low debt and strong equity. Risks? Sure. Margins are under pressure from inflation, especially in raw food inputs. Kagome also faces competitive challenges in international markets, where its brand recognition isn't as strong. There's also the Japan-specific issue of low inflation and population decline, which caps domestic growth. So why look at Kagome right now? From a value investor's standpoint, it's a stable, dividend-paying company with a recognizable brand, clear product differentiation, and a history of profitability. If you're seeking reliable exposure to the defensive consumer staples sector in Asia, and you're okay with slow but steady, Kagome might deserve a closer look. On the other hand, if you're chasing rapid earnings growth or deep discounts, there may be flashier plays out there. At Insightful Value, our focus is on clarity and context. We break down undervalued companies and give you the tools to understand why they might be worth your time. Whether you're a long-term dividend investor or just want a well-researched stock idea from outside the usual headlines, we've got you covered. Find more insights like this at InsightfulValue.com. And hey, if this video gave you something to think about, hit that subscribe button and stay updated. Visit InsightfulValue.com to explore more companies flying under the radar.